Thank you, everyone, for staying for the last panel before the break. Hopefully, it's one of the more informative panels on LPs. So, can I just have a raise of hands to see how many people in the room are GPs actively or have raised or actively raising for their funds? Really? What are the rest of you doing here? I hope the rest of you are LPs and going to throw money at me after this panel. But so as Beji said, my name is Ray. I've been at 500 Startups for the past 3.5 years. I oversee a couple of responsibilities, but one of them does include fundraising. And as she said, we are in the middle of raising Fund 4. I'm very lucky today to be joined by 4 awesome, experienced LPs, institutional LPs, who are all very experienced in venture, and specifically, some of them are very experienced in seed funds. So I will introduce from left to right, John, who is a senior investment analyst at WARF, which stands for Wisconsin Alumni Research Fund Foundation. And Edwin, who's a co-founding general partner at TrueBridge. Erik, Lassila, who is a U.S. managing partner at Peakview Capital, who is actually one of 500's LPs. And finally, Erik, principal at TopTier. I'm going to ask the panelists to give a very concise overview of their funds. So specifically, I'm going to ask you 4 questions, which I outlined in the email. Please state your AUM, your exposure to venture, your exposure to seed. If you can talk about your years in existence, because there is a variation up here, as well as your source of capital, just so everyone can understand where you're coming from when you discuss your investment philosophy and strategy. And if I can just start with John over here on the left.
Great. Yep. Thanks for having me. So the foundation that I work for has been around for 90 years. It's $2.6 billion in assets. I work with a team of 7 folks to invest that money. Roughly 5% of the endowment is in venture. We've been in the venture space for the greater part of 30 years in various different ways, and so our strategy is always evolving. And then as it relates to seed, about less than 1% is dedicated to the seed manager, one manager.
I'm Edwin Poston. TrueBridge has been around 9 years. We manage 1.75 billion. 100% of what we do is venture. Our premise is we want to have a concentrated portfolio with the very best managers. We have 10 or 12 marquee relationships with primarily Northern California early stage managers, plus about 15% of our capital goes into seed. We have about 10 or 12 relationships there. And 16 of us, again, focus 100% on venture.
I'm Erik Lassila. Our firm, Peakview Capital, has been around for about 10 years. We have about $3 billion under management, and we invest that between 3 geographies, China, U.S., and Israel. I manage the U.S. part of it. We deploy a couple $100 million of new commitments per year to early stage and growth venture, and also a little bit of specialty buyout funds. We only have made 1 commitment so far to a seed stage firm, and I'm happy to say that's 500 startups. And and our strategy is to invest in groups for long periods of time. Our capital comes from China. We're a Chinese fund of funds, so our investors are high net worth individuals and government funds in China, and then we deploy that and invest in U.S. groups.
Cool. So, first let me say we got to give kudos to our fund of funds lobbying group for getting 3 fund of funds up here on one panel. But seriously, so TopTier Capital, we're venture fund of funds. We focus on primary investments and funds. We also do secondary investing in funds and companies, and we have a co-investment practice. About 10% of our capital among our fund of funds program is dedicated to what we call alpha managers. That's any fund that's less than $250 million in fund size. So we have a separate pool of capital for that, and we're pretty active in that space. TopTier was founded in 1999, 5.3 billion assets under management, and most of our LPs are sovereign wealth funds and pension plans.
Thank you for the introduction. Actually, it wasn't super easy to get, I think, 3 fund of funds on the same panel because there aren't that many, actually, fund of funds exclusively focused on ventures. So TrueBridge, TopTier are definitely rarities. Most, I would say, of the other institutional LPs I've talked to look a lot more like WARF with a alternative asset base and then some, minority allocation to venture. So since, I was told what the title of this panel would be, and that is what LPs really want. So that's going to be my first question, very basic. What do you look for in a seed? What do you look for in a manager, actually? And so could I have, I guess, the panelists go through what are the top couple of things you look for in a seed manager? And then especially Edwin, I'd love for you to talk about your experience vetting one of the premier seed funds that we talked about on the phone.
Our money back, I guess, would be the first thing that we look for. So I think we spend a disproportionate amount of time just thinking about who we are and what we bring to the market. So, this is a very, very competitive landscape, and with very institutional players vetting all parts of the market. So the first thing that we do is just think of, what does our capital look like relative to the other providers? And then we kind of self-select into one part of the market or another. So that is kind of the harder part of our job, is really just identifying with who our key constituents are, what our areas of expertise are, and then we kind of naturally migrate into a certain area of the market. Beyond that, just having the same level of understanding on the other end of the table. Do you know who you are? Do you know what market you're addressing? And have you built up capabilities around those things? But yeah, money back first.
In simple terms, we look for 2 things: a great track record and terrific deal flow. So it's easy and obvious, especially when you're picking firms like Sequoia or Benchmark. But that's probably not the question you're asking. You're probably asking, how do you find the next Sequoia or the next Benchmark? And so it's not always the track record from being an investor. It might be a track record from being an angel investor or being a terrific executive. And the example we use fondly is investing with Chris Sacca. When we first met him, we were blown away. He's an engaging guy. One of the benefits of our firm is we don't do anything other than venture. There's 16 of us that focus just on venture, so we have the ability to spend the time to kind of track down everyone to see if what Chris was telling us was actually true. None of our colleagues in the foundation endowment world or other traditional LPs knew of Chris, had invested in him, so that was a dead end. But we called his entrepreneurs, and they were over the moon about him, just unbelievable references. So that gave us the gumption to back him early when he didn't really have the track record, and he wasn't the Chris Sacca we all know today. So it's a track record of success, hopefully in investing, but it can be in other areas as well.
So we sort of think about all of the things that we track, the metrics, all the numbers. I think it really boils down to 3 things that we look for when we invest in a venture group. And the number one is sort of, to the extent you can have it today, some source of proprietary deal flow, some unique access to companies that other groups are just not able to penetrate. And sometimes that's relationships. Someone who's been investing for a long time will have worked with generations of entrepreneurs. And it tends to favor the brand name groups that have been around for a while because they have that reputation, but quite often the newer groups just have the hustle and are able to build a platform, and this is why we're investors in 500 startups. They have a kind of operational layer that gives them proprietary access to great companies. So that's number one. Number two is about judgment and looking at track record. Can be deceptive because in up markets you have increases in value without necessarily having distributions. But if you look at someone's history of investment and ask them, hey, why did you invest in this company? What was the motivating factor? You hope that you have some level of thinking underneath that goes with the path of the markets and the entrepreneurs that they back. And it's really the thoughtfulness and strategy that goes behind those investment decisions. And then the third thing was really that energy and motivation. Are you still hungry? A lot of firms have done so well, and maybe you've made a lot of money, but you're still wanting to build something and create something that's long-lasting and important and impactful. But the younger groups sometimes tend to have more drive, more to be out there and to be meeting the next generation of entrepreneurs. So for us, you have to have all three.
So maybe I'll answer it a little bit of a different perspective. So peel back the onion and think about what's the mindset as an LP and especially a fund of funds. So we think a lot about portfolio construction. And so if you think about investing in venture capital funds today, you have reputable brand names, oversubscribed funds. We think about those as core relationships. And mapping those along our allocation map over the 30 months or so in our investment period is pretty straightforward. We generally know when they're going to be back in market, how long does it take to close those funds. And so that's a pretty straightforward process. But if you think about seed funds and micro VC, one thing that TopTier realizes, you actually need a separate pool of capital, right? Because it's a different mindset, it's a different thought process in terms of how you look at those relationships. But having a separate pool gives you the ability to have multiple shots on goal. So it's a different way of answering the question in terms of how we look at it, and that also helps inform on how you may position yourself when you're trying to approach LPs like ourselves. And just to directly answer in terms of one thing that we really look for, and what we appreciate being here in San Francisco for all these years is the network, right? It's a little bit esoteric, but if you think about the strength of the network and how it touches upon deal sourcing, winning competitive deals, due diligence, value add. If you don't have a special network and those network effects, it's basically a showstopper for us.
And for the LPs on the panel, there are a couple of you that co-invest with your GPs, right? Can I have a raise of hands who on this panel co-invest? Okay, so everyone co-invests. And okay, so that leads me to my next question. So what do you do that's different, right? I know on the phone I asked all of you to sort of discuss what do you think are innovations on the LP side. I know John has some special perspectives because you're affiliated with the University of Wisconsin. So you like to think that you guys have some different value add that you bring to the table when you do invest in a company. Oh, sorry, in a fund.
Yeah, I would say we're just, I don't know if value add is the right word. I think we're clear in our intentions. The relationships that we'll co-invest on, they are all technologies that are related to the UW. So the UW is one of the top 3 research institutions in the country. Receives more federal funding than Stanford and UC Berkeley, so I have to say that while I'm out here. And so we have very strong regional partners that they've made it their business to make UW a part of their deal flow. And so we work very closely with them as an LP and as a co-investor. And we're a significant part of their business. So, there's always the adverse selection bias that people reference in co-investing. So making sure the alignment is there on both ends of the table is key. And so we've been co-investing for the greater part of a decade and with a lot of good success. Low loss ratios, top quartile performance.
And you guys have a large portfolio management team as well on campus, right? That help try to integrate
Yes.
campus companies with like funds and stuff, introduce them, et cetera.
Yeah, and I would say the way that we have approached that part of what we do has evolved over time, and 500 startups and the whole accelerator movement, I think, has kind of changed our thought process of exactly, should we do this internally? Should we partner with premier groups that are professionals at this? And but yes, so we spend about $3 million just trying to glean ideas off of campus and institutionalize that early stage process, and third parties are a big part of that.
Very cool.
So for us, I think it's two things. We have a very large team and are very quantitative. Our industry is typically, the LP community is typically very anecdote-driven or brand name-driven, and we try to be very quantitative. We have been quantitative since the inception of our firm. We are the muscle and the engine behind the Midas list. We actually put that together, and Forbes publishes it on our behalf. And I think that quantitative element brings something different than most LPs. And we have a concentrated portfolio, so we know our managers really well and their portfolios really well. Again, 16 people for about 10 relationships allows us to know the underlying companies really well.
Yeah. I want to ask the two Erics something different, just because we're running out of time getting these 3 minutes left. I'd like to ask Erik of Peakview, what do you think of the increasing way venture firms are becoming more like platforms? For example, like 500, First Round, Andreessen, et cetera. Do you think that's positive, negative? Do you see any boost to performance, et cetera?
I think you have to nowadays. I mean, it's such a much more open market than even 10 years ago in the venture business. So it's super competitive, and you have to tell the entrepreneurs who you are, what you believe in, and what you're looking for. So you have to market, and platform, I guess, is another way of saying, a set of value-added services and communicating to the entrepreneur community. So yeah, I mean, it's not only a competitive weapon; it's sort of a must-do nowadays.
And you're able to say this with conviction because you were 18 years as a VC. Is that correct?
Yeah, and when I started, it was a very different thing. You sort of sat in your chair and people come to you. Now you got to get out there and hustle.
Great. Erik of TopTier, I'd love to know, are you looking anywhere different? So outside of, let's say, Northern California, outside of, internets, are you looking at any other regions, for example, rest of the world, or different sectors, such as health sciences?
Well, specific to seed funds and micro VC, again, we have, I think, the benefit, we're building a portfolio of 10 to 12 different relationships, so we can build some diversity into it. So again, some of that might be geographic diversity. We have a commitment in LA, we have a couple commitments in New York. We actually have an expansion stage manager, so we can think about, gosh, these are seed stage managers, how do we perhaps eliminate some of that J-curve effect? We actually have a manager that's focused on Series B and Series C in the enterprise space. So we're pretty strategic and tactical in thinking through how we would build a risk-return profile that gives us exposure to this space, but also can maximize the potential for performance. So some of that does mean we'll have some geographic diversification. And then we also think a lot about something we're going through now is about frontier technology, right? We hear a lot about drones, VR, AR, machine learning, autonomous vehicles. And so that becomes another area of opportunity for us looking at seed funds and funds that are focused and specialized in that space.
Thank you. I think I'm out of time. I had originally 7 questions, but I think I only got to ask 4. If the audience has any questions, I'm sure the panelists are happy to stick around. So thank you.